All right. Good morning, everybody. It is a quiet morning, but it's going to be a busy week. We have a lot of Fed speakers. That's really the only thing on the docket today. We've also got European speakers too, so a little bit of caution there. We have CPI this week, and we have Powell speaking, although, he's not going to like set policy, right? But if the run from Friday continues today and into tomorrow when he starts speaking, he might do another mic drop moment like he did in Jackson Hole, Wyoming. We'll have to see, right? They certainly have the capacity and the power to move this market whichever direction they want to go. So pretty light on the economic agenda part. Basically just watching the clock to see who's chipping teeth. NVIDIA is up this morning, but we'll come back to that. So we do have additional auctions today at 11:30. That's the end of it right there, other than the speakers. And it should be just a pretty non-event morning. I think a lot of this week is going to be hurry up and wait, which it seems like we've been doing nothing but hurry up and wait now for 7 weeks. The volume's just about where we would expect it, but the IB, the initial balance, was really small. We've only just recently started to expand beyond it. And at this point, we do have an inside day breakout. Not much of one, but it is there. This green line at 39.28 is yesterday's high. We managed to get out of it. Really can't consider this a Busby since price never went anywhere, right? It just broke out of it and lingered there now before starting to expand beyond it. We have an MDP that's a missed daily pivot. Markets hit their pivot more than 80% of the time. So when they don't hit it, it kind of stands out a little bit. We are also above the weekly pivot. When we're above the weekly, we consider the market to be more bullish than bearish. We should be looking for, long opportunities. Of course, if the market was to start going down, it would need to get through that pivot, but it's not a support and resistance level. So kind of keep that in mind. It's not in any way making a promise to act as a support level. It's not even a supply and demand area. It's just a math formula. So we still got the lines from last week. The box that we had drawn, we are outside of that box. We don't really have explosive economic anticipation today, but later in the week. So we'll just keep these 150s and 200s since they still apply. It's the measurement of this range. All right, 10-day, 30-minute volume profile. When we're at the bottom of the profile, we expect to go to the top. When we're at the top, we expect to go to the bottom. When we break out of the profile, we expect to come back into the profile. Still relatively shallow up here. There's a minor volume shelf around 39.20, but that's not expected to really help out any at all, considering how small it really is. Should we break back down inside of 39.20? It's very likely that we will move back to the cog line at 38.50 really fast. You can see how it's shallow. There's no real volume nodes or volume support in that anywhere. Five-day, 5-minute volume profile. We do have a VPOC from yesterday. That's around 38.90. This also is not a support level. If we come down and make contact with it, price is likely to respond there. Could get a first touch bounce, or maybe anticipate a pause, a reaction in price. Certainly not support. If we get near it, it will become a gravity as well and kind of get pulled to it. So when we looked at this Friday morning, the box for this week was a lot bigger. During the day on Friday, it shrunk up a little bit. The bottom of the box is also a cog line this week, 38.11. So they priced in a little bit more volatility this week, but not as much as they were pricing in Friday morning, right? So by Friday afternoon, they had really dialed things back a little bit. $39.34 is pretty much the line in the sand. If we can get above that, we can start focusing on 40.50. Banks are going to kick off the earnings season. Earnings season starts this week. And the first thing they talked about this morning, and what I heard a lot this morning, was about the banks and a really big bank cutting staff, trying to reorganize in such a way to reduce their cost. Banks usually set the tone and lead the rest of the earnings season. So it looked like the pot stocks are getting a little bit of action this morning too. All right, so we've had stocks and bonds moving in the same direction a lot, but not today. TLT is down more than 0.75%, while the ES is up this morning, nearly 0.5%. So a little bit of divergence there that we haven't seen as often this year, so far at least. So this morning we're going to be opening down right about that 104.25 area. And that big bar from Friday is going to be the controlling bar. We do have a market maker move on the TLT. And crude finally broke this really tight range down here. This is what I call a failed flag. So in a general flag, right, you got the flag pull, then price builds a base down here, and a flag is supposed to be a continuation pattern. So it builds the base, and then it's supposed to break lower and continue to the downside. But it starts to give a little bit of a heads up when it continues to go sideways, right? The flag itself shouldn't exceed about 1/3 the length of the pull, or it starts to give a little bit of concern that maybe this isn't going to be a continuation pattern after all, but instead start to form a reversal pattern, which ends up eventually becoming a massive cup with the handle. So right now we're focused on reciprocation levels with energy, looking back at 50% of the flagpole for kind of a line in the sand. Should not cross of around 77. Needs to stay below that if it's going to maintain its bearish posture, right? Because it still could just be a pop up before rolling down. This could be what they call a draw here. It's where it draws in liquidity. Players start picking a side, setting their stops on each level. And then it raids into the liquidity, gathers up a bunch of orders before heading to the downside. It could be that, but the way the failed flag play works is we anticipate a little bit of a Busby, come back down and retest off of the flag part, and then look for the continuation to the upside. This should tie in with that capital rotation that we've been looking for. And if we do start to see that rotation, we're very likely going to see the VIX continue to head to the downside, which this morning it tested $21. If it doesn't find support there and breaks below $21, we're going to expect to see the S&P get above that 39.50 level. So bonds are down, the dollar's down, those two definitely have not been running in sync together. We got the China names up this morning, including emerging markets and KWeb. And then all of the different energy names, including natural gas, oil services, crude, exploration, basically everything connected with the energy is up. Now, TAN, which is solar, isn't up, but it's not down either. Other than TAN, everything else connected to energy is up. If we look at the VIX futures, the VIX is down slightly, about 0.25%. But if you look at the VIX, it says we're up. We had that gap up this morning. I think that the VX makes more sense. It looks more like the dollar, kind of a range bound, flat, really not going anywhere. I think the main takeaway is that we're really struggling here to keep outside of Friday's price action. And we've got a very serious topping pattern. I know it looks a bit like an inverse head and shoulders, but an inverse head and shoulders shouldn't be at the top of the range. It should be at the bottom of the range. It's a bullish reversal, right? So you see it in a bearish market, you get an inverse head and shoulders and then a bullish move out of those lows. It's not a continuation pattern where you see it at the highs and it intonates some continuation that we're going to go higher. That's not what it's meant for, right? So if you see a head and shoulders at the highs that is inverted and pointing to the upside, you really want to mistrust that thing. Don't try to play it as a head and shoulders up there. One thing that gets my attention is they're doing all of this work. They're trying to trade it out, and yet they're really not getting anywhere. All right, so with banks kicking off, keep your eye on the XLF and KRE. For the XLF, holding below $36 is kind of going to be our benchmark. One of the reasons that I like trading banks, especially on the intraday, is they kick off earnings seasons. They get that out of the way right away. And I don't like to trade in a swing trade knowing that there's an earnings event coming up, right? So every time we kick off earnings season, all the things that I normally would want to swing trade, I can't because it's got earnings. Well, banks get that out of the way first, right? So they kind of become the first thing that we can trade into when earnings kicks off, because once they've had their earnings report, I don't have to worry about them having earnings anymore. Now, if we look at KRE versus the XLF, KRE is more towards the bottom of this range, closer to the lows of 2022. And XLF is sitting near that August high, right? When the market rallied back between June and August of last year. We've got a market maker move in just about everything. The Qs have one, SPY, the financials, KRE, XLF, energy, everything that we look at has a market maker move this morning. The market makers are ramping up that front side volatility, which is where market maker move comes from, right? This number comes because this front number is higher than the back number. Percentages, right? Not the movement. Yeah, this really looks like a topping pattern. There's nothing on the docket that can really give us a push higher, especially in front of the CPI. Right? You really got to kind of ask the question, why would any of those institutions or big firms come in and trade before the CPI when the CPI is going to be a significant event that could likely reshape the rest of the market into February? And of course, the answer is they wouldn't want to. All right, so let's use VIX at $20. If we can see the VIX break down below that $20 level this week, we could see the S&P leg up above that 39.5 and into the 4,000 area. And if the VIX starts to challenge that $25 level and breaks above $25, then we could see the S&P begin a new leg down below that 3,800. Actually below the 37.5 and into the 3,700 area. Continue to watch the dollar close. I know on an intraday, it hasn't really been as helpful these last 6 weeks or so compared to how well it was working through the year. But look at it on a bigger picture and it still continues to offer some insight. We're going to look at it at, I'd focus on that round number, that 103. And as long as the dollar is holding above 103, we really can't expect the S&P to leg up into that 4,000 area. If the dollar begins to break out and run back to the upside above 105, we should see the S&P back down to that pivot point, that 3,800, above 107 into the 108. Then we see the S&P testing that 3,750, 3,700 area. And a breakout above 108 here, we'll be looking for a breakdown below 3,700. Otherwise, with everything range bound and just on hold, the VIX, the dollar, the S&P, everything is on wait. For the China ADR names, Baba, Futu, PDD, those are some of the bigger ones we tend to focus on, but Neo, Li Auto, and JD. It's a surprise to see JD so flat. So this could be an outlier, but it might be a little bit of a trigger. I used that this morning, the way that we use, say, like emerging markets or KWeb. We really want to see JD get off the bench and get into the game, and or see if it even holds positive at all and is the leader to a downside move. NVIDIA was up, is up this morning, looking really good. So if we look at what else is going on in the chip space, I mean, there's a few that are down that fit into the space, but don't necessarily run chips, like some flat names too. But if we get through that and start looking at the bigger, well-known names, Intel, MU, SMH, AMD, NVIDIA, right on up the list. So we had that really nice wedge on the daily in TSM. And for NVIDIA, I was kind of mapping that out before I started the briefing. Above 150, we can start to run towards that 165. But I would continue to use 50% of this week's candle. So 157.55 is going to be kind of the line in the sand there. If you try running long in NVIDIA, be cautious of that 157.55 area. Now we're already up to 151. So we're really close to being above that pink line that I have there. We'll be in a IX10 breakout. Because that line in the sand is 151, right on the dot. Looks like we've pulled back just a little bit. So you can see we're flirting with it. But again, these look like topping patterns this morning. A rejection at 151 today. We'll start focusing on NVIDIA back to the downside, and it'll be 50% of this candle here. 145.78. All right, there's this market logic called the 5-bar rule. You can attach a little bit of weight to it if you want. The idea is when a market has set 5 bars in a row, either all red or all green, then you expect a change in market structure. Got to give it a little bit of grain of salt, right? Especially with something like Apple, which has a history of 9 to 12 bars. Having said that, though, you can count back the number of weeks here where we've been red and look at the wicks along the bottom where it's getting defended. A market can do whatever it wants, but we have the capacity for another dead cat bounce across the board in a lot of names in the market right now. Tesla being a shining example of something that is seriously oversold, kind of due for a little bit of a bounce. But just because it's due for one, because it's traveled so far in one direction, doesn't mean it's actually going to give us one, right? Because it doesn't owe us a move like that. So everything is CPI this week. Maybe a little bit of POW, although, you know, we really have a little expectation that he's going to come in, you know, with another mic drop moment like he did in Jackson Hole. We need to resolve this range that we've been working on for the last few weeks. And so far this morning, we're outside of that range. All right, so now we just got to keep it. Now, the way this generally works, if it's going to be a fake out, then we're going to expect a little bit of a wick on the upside and then back into the box, and a little bit of a wick to the downside and then back into the box, right? Just like we were doing back here. Where we wicked out, came back in, wicked out, came back in, wicked out again, came back in, and then a downside move that stalled. Through the morning today, we want to continue to focus on the bullish move as long as the S&P maintains this inside day breakout. But look for all of it to unravel. %30 of the S&P this morning is up at least 0.5%. That's mildly bullish. It's not very bullish at all. So we needed to pick up speed. KWeb and emerging markets showing that the China ADRs are doing good, but that's not enough. And we're not going to see, you know, the short covering rally across the board in, you know, 70% of the market. We don't have that kind of breadth. So we're not going to get any assistance that way. We could get some help from the oversold names, the mega market cap oversold names. But what's going to trigger that buying? Just the fact that they're oversold isn't going to be enough. So we need breadth to really pick up, and or we need those mega market cap names to get into the game. On the NASDAQ, 36% of the NASDAQ is up this morning, at least 0.5%. And that's not overly bullish either. It's mildly bullish. So we've got a topping pattern. It looks like everything wants to reverse. We got a market waiting on big econ this week, so very likely a lack of serious participation. And while the China ADRs are looking good this morning, energy is also looking good this morning. And we're going to, if we continue to see that move up in energy, then it's going to be the focal point for this capital rotation that we've been waiting on. So we're in a paradigm shift. keep in mind that it's very rare to have 2 back-to-back trend days, solid, strong trend days like that, right? So we could just base and range here in this topping pattern without actually falling out, or we could reverse, and as long as we're holding above 50% of Friday, any reversal would still be just healthy. It would be a decent pullback after a really strong run on Friday. So just because we get a mild pullback this morning, as long as we're holding above 50% of Friday's level, the market can still be bullish. It would just be harder to chew on that bullish bias because we would be back in that range again. Everybody be careful, be safe. Have a good morning. I'll see you all tomorrow.